Welcome to Financial Revelations. I am your host, David Safransky, and we are back this week with some new data that I wanted to go over and tell you how it's going to affect us, the market, our money, the economy, the government, the Federal Reserve. There's a lot to go over, and we're trying something new because word on the street is I tend to ramble sometimes, so I have to be on a counter. So I bought a countdown clock, and it's kind of right over there someplace, and I got to keep an eye on that thing every once in a while. On Twitter, you can get us at at FI Revelations, at FI Revelations on Twitter, and I want you to follow me there because what I'd like to do is a bunch of surveys. It's not asking you, I don't have your information specifically, but just some things about the economy, ask some questions, get some feedback. I'd like to go over that, share that here. And I know it's not scientific because it's self-selecting, but I like to know what people are thinking. It helps me prepare for the podcast, and I think people are interested. So at FI Revelations on Twitter, and you can also, if you have questions, comments, you can email Joshua at epsf.com. He's going to put that address up here, and you'll see that in a second. He's also going to put the Twitter address up because somebody had called me and said I couldn't find it. If you just type in Financial Revelations in Twitter, we'll come up. So the thing that I'd like to talk about today, and we've kind of mentioned this very frequently in the past, especially the recent past, but what I promise is as the data changes, we're going to bring that to you so we can talk about it, and that is inflation. And the inflation data came out this week, just yesterday, and it is really hot. In fact, it is lava hot right now. If when you were a kid, you used to play the lava game on the floor where you couldn't walk on the floor. This is getting like the lava game with inflation. So the producer price index, which is the price that the people who produce the things that the goods and services, was up 1% in June. 1% in 1 month. That is really unheard of. And if you think about it, if you did that 12 months in a row, it would be 12% inflation. Kind of reminds a lot of people of the late 70s, early 80s. It's not uncommon you talk to somebody who had a house at that time, their interest rate on their mortgage would have been 15, 16, 17%. Now, I don't think we're going there. I don't want to be an alarmist or take a few numbers and just run with those numbers. I think, especially with inflation, you have to plot these things over time. So you're going to get hot months, you're going to get cool months. We've had several hot months in a row now, so I do have to believe that this trend, even given COVID, has some reality to it. There'll be some things that come off, and we'll talk about those in a second, but the PPI year over year, and that's what I really look at is year over year, is up 7.3%. And we're looking at autos, auto parts, housing, energy, lumber. Lumber is one of the bright spots with inflation. It is way off of its highs. It is still really high, but I was talking to a contractor in Florida yesterday who said their cost of lumber has dropped pretty significantly over the last 30 days. In general, the expensive lumber that's in the system takes about 60 to 90 days to kind of get out of the system because places like Home Depot and Menards and Lowe's have bought this expensive lumber. They're going to keep it priced that way until it's sold, and then they'll start bringing in the lower price stuff. Now, the consumer price index, which is the prices that you and I pay, we pay it at the pump, we pay it at the grocery store, we pay it in a lot of places. Everywhere you shop, you're paying whatever the consumer price index is. It's up over 5.4% year over year. That's a really hot number, and in fact, these are some of the hottest numbers in history that we've ever seen. Now, the Fed chairman, Chair Powell, he likes to say that these are transitory, that COVID is really the reason why this is happening. You think about it, used cars are as expensive as they've ever been, mainly because nobody worked last year for a lot of the year. Starting in March, really, a lot of people were off for 3, 4, 5, 6 months. They didn't go back to work because of COVID. You didn't build a car. You didn't build a house. You didn't cut down a tree to make lumber. You didn't do any of that stuff. So there's shortages. And in economics, one of the first things you learn is supply and demand. And if supply goes down, So there's less of whatever you want, and demand is steady or rising, prices have to go up. That's what happens. So suppliers can charge more. So right now, if you go to the dealership, for instance, I'm trying to trade in my truck to buy a new truck. There's just no trucks. There are literally, there's a dealership right down the road from here that would usually have, 300 F-150s at it. When I drove by this morning, there's like 10. That's all they have. So the supply is very, very limited. Price has to go up. If you don't need to buy a car right now, I would significantly and severely avoid it at every cost. Do not buy a car right now if you can avoid it. Now, there's some people for work, they have to buy a truck. That truck is going to get bought. It's going to get bought expensive. The main point with inflation is that as prices rise, it's a tax, but it's not a progressive tax like the income tax. It is a tax on everybody, and the lower your income is, the more of an impact it has on you. So it does hurt the lower end of the socioeconomic scale much greater than it's going to hurt a wealthy person, because they're still going to do all the things that they want to do. And this is very problematic for the Biden administration. It's very problematic politically for people, because it makes everything more expensive. And who do you blame? You blame the people that are sitting in the seat of power, and that's who's there right now. So what's going to happen? What is going to happen if inflation continues like this? Let's say the Fed is right that they're transitory costs, temporary in nature. If those numbers stay high longer than what we thought they would, it's going to be problematic. And so here's what the Fed is going to have to do. And I'm thinking, I have long said that I thought that the Fed was going to have to act a little faster than what they thought they were. And I think the Fed is going to taper their bond purchases somewhere in November or December. At least start talking about it openly. Maybe they don't do it in December, but they're going to have that discussion in the open, in the wild, for the first time. And what that means is for every bond that the federal government issues, our Federal Reserve, the people who manage the money supply, are buying about 55% of that debt. As they stop buying that, interest rates are going to gravitate upwards. And it's going to be the first sign when they have this discussion in the open. There's a Fed meeting in 2 weeks. My guess is that they're going to have this discussion and then talk about it in the press conference, and they're going to be asked about it a ton. So it's unavoidable now. They're going to be talking about tapering. It's the first indicator that rate hikes are coming, because before they can increase rates, they have to taper bond purchases, because it doesn't make any sense to increase rates while you're stimulating the economy. So they're going to stop stimulating with money, see where that leads us, and if the data is good and they don't have to raise rates, they might be able to wait a little bit longer, and that's entirely possible. But the market's going to see this as rate hikes are coming, the first indicator. And I think it's going to happen at this current data trend, the way we're looking at the numbers. I think it has to happen. The discussion has to happen, and probably in practice, November, December. These numbers are just too hot to ignore. And it's unfortunate, because we are in this, the economy is super hot right now because of the reopening trade, and that's still going on. I was looking at TSA numbers this morning about how many people that they were clearing through TSA. And when you look at this on a weekly basis, it just, even in the best times in air travel, it just looks like a jagged sawtooth. When COVID happened, that jagged sawtooth still happened. It just dropped dramatically and precipitously to levels we haven't seen since the Wright brothers. I think more people flew on the first Wright brothers plane than were flying last June. Well, that number has gravitated upwards again, where we're clearing over 2 million people on a Friday and a Sunday. And when business travel comes back, it'll be Friday, Sunday, Monday, Wednesday that you get those 2 million people. But just like that, jagged tooth. Now, instead of being way down here, the jagged tooth is up here. So a lot of that reopening trade still has to happen. The travel leisure stocks still have to grow. The cruise lines haven't really picked up from to the point where they were before COVID. That's still going to happen. And so they're going to the Fed is going to taper, even though that the economy is going well. That you can't ignore these inflation numbers. We're going to taper. The economy is still going to be opening, and I think that gives the Fed some cover, and it gives the Biden administration a little bit of cover for a little bit longer time. And then I think sometime next year, the Fed is going to probably raise rates a quarter point. And it could be towards the end of the year. It is the midterm elections next year. The Fed traditionally likes to stay out of politics, although they don't really do that very well. They may have to be in politics next year, because if that rate hike comes before the midterms, it's going to significantly hurt the people in power. So that's what I think is going to happen with rates next year. You're going to see, when the Fed does openly talk about tapering, it's going to be a buying opportunity in the market. And this is why I think that. When the Fed changes direction, it doesn't really matter what the direction is. When they change directions, the market really has a moment where they have to take a breath. And in that moment where they're taking a breath and stocks might drop 3, 4, 5%, it would be a buying opportunity, because this reopening trade is going to go on for the next 6, 8, 12, maybe even 18 months. As Europe is still pretty much closed. I was just in Europe. For the most part, they're 3 months behind us opening-wise. And some countries, not even close to where we're at now. That bodes well for us. That will continue to open. Companies will continue to do better year over year. And that's what the market looks at, year over year numbers. So we got to be ready. We got to be ready to deploy some cash to the best companies that get hit the worst. So we want good companies on really bad news is a great investment. And it takes a little kind of balance, rhythm, and patience to do this, because on the first bad day, we're going to want to buy. You need a little patience. You want to balance things out. You don't want to get overweighted in any one particular area. And there is kind of a rhythm to this process where we're looking at it, we're deploying, we're looking, we're patient. So a little patience, a little balance, a little rhythm will serve us all very well here. And, I like to think that as we're watching these markets perform or not perform, or companies report or not report, for instance, Bank of America came out and reported a bad number today. Rising rates are really good for banks. They're just great for banks. They make a lot more money in rising interest rates. They don't necessarily give you a whole lot more in your savings account or your CD, but they're making a lot more money. And because the economy is strong, I think it's going to be particularly good for banks. It could be a buying opportunity for banks if they get beat up on the taper news. So got to be ready for it. We got to be watching the best companies on the worst possible news. Some of that news is coming, but I don't want you to fret, because there's always a market where you can make money in, especially in the great companies. And the best companies in the world right now, and it's without fail, the best companies are all American companies. China is really cracking down on their publicly traded companies. They just don't want them to be wealthy right now. And so they're really cracking down on CEOs. They're cracking down on pay. They're cracking down on when they go public. It's very, very difficult to look at a Chinese company right now and want to invest in it. There's just too many unknowns. And so that leaves the biggest economy with the most growth potential and freedom behind it. It's right here in the United States. So we're going to be looking mainly domestic. As Europe opens up, we may change that a little bit. But again, as the data changes, we're coming back to you. And that's why we came back to you on inflation today, because the data changed, and it changed significantly. So remember, at FI Revelations, it's going to be right here someplace, FI Revelations for Twitter, Joshua at EPSF.com. And you can always go to our webpage, EPSF.com, if you want to. But I'm giving you everything you need to know here. You're not going to get any of this stuff at the website because it's so time sensitive. And so that's why we do the podcast, so that we can be time sensitive with it. I am David Safransky. This is Financial Revelations. Have a great week.